Imagine being able to predict market movements as if you had a crystal ball in your hands. That's exactly what the Fibonacci indicator allows you to do, and I'm going to show you step by step how to use it. This is Leonardo Fibonacci, the creator of the Fibonacci indicator you surely know. But I know what you really want is not to know his history, but to learn how to apply his model to your trading. So take notes and watch how to do it. In trading, Fibonacci ratios, mainly 23.6%, 38.2%, 50%, 61.8%, and 78.1% are used to identify potential levels of support and resistance. These levels are incredibly accurate in predicting where prices might head next. For this, let's go to the EUR/USD chart. A Fibonacci retracement is a technical analysis method that uses percentages and horizontal lines drawn on price charts to determine levels of support and resistance. And that's exactly what we're going to do here. How to use the Fibonacci retracement. First, we graphically identify the trough and the peak of the trend. Then we select the Fibonacci retracement tool on Trading View and uncheck all the levels we're not interested in. In this case, we want to keep only the levels 38.2%, 50%, and 61.8%. These lines represent the levels of support and resistance where prices may retrace, following a change in trend. Thus, after an upward trend, the 4 retracement levels will help to set theoretical supports within the technical correction that follows. And obviously, these levels will help us obtain signals. What are the best Fibonacci levels? The 3 most important levels are 38.2%, 50%, and 61.8%. There's no best level, but these are at least the 3 levels I recommend because they have a higher success rate than others. Let's take an example here. We have CHF-JPY and decide to apply the Fibonacci retracement between this high point and this low point. And then we could have found 3 entry points in a few minutes with the first here, when this wick rejected the 61.8% level. The next on the same level, which was a level where this range established more bottoms before rebounding. This could therefore mean that a break of this level was a good sell signal. Finally, the third entry could have been here on the 50% level, and it's impressive. But on 4 occasions the wicks rejected this price, which was a signal that a sharp drop could appear. Now imagine that thanks to the Fibonacci retracement, we decided to take these positions. Here's what it would have given: 3 profitable positions. We can now do exactly the same with EUR/USD. For this, we identify this important downtrend, and we will use it to identify the highest and lowest point. You must already identify very interesting levels. First, the 38.2% level, which at the beginning of March, after a breakout upwards, served as support for EUR/USD, and then it led to a rise of 115 pips. But there's even more interesting here. Look, on March 7th, this wick rejected the 61.8% level, which was potentially a sign of a change in trend after this powerful rejection, and indeed, the price then dropped after reaching this level. Same here, there's a consolidation between the 50% level and the 61.8% level, and then the price breaks the 50% level and drops by 125 pips. So this is interesting, but these last 3 days, by applying the Fibonacci retracements, you could have taken this 90 pip position. Indeed, the last level, which is the 38.2% here, served as resistance after a significant pullback. Then, the downward movement appeared. But we used an even more powerful indicator to be sure that our signal was strong. We used the bank targets. It's simple. We noticed that the bank targets for the month of March looked like this, and we especially identified that the average of the bank targets gave us exactly the level where we were. Then, by analyzing this level, we noticed that it had served as resistance on several occasions, and therefore that the price would then drop. This was an important signal we had there. These bank targets are a powerful indicator to identify key levels before prices drop or rise. Here's how to use the Fibonacci retracement and combine it with the bank targets to get powerful signals and transform your trading.